Picture a company that is completely, and I mean entirely, untouchable. An absolute titan of industry. We are talking about a tech monopoly that held over 40% of the entire global market in its iron grip. They had built the greatest, most complex distribution network in human history. Their profit margins were absolutely massive. Their cash flow was so reliable, so constant, that it was practically like having a license to print money in their basement. If you were a Wall Street investor or just a regular person looking for the safest possible bet on the planet to park your money, this was it. It didn't get any safer than this. But then, almost in the blink of an eye, this invincible empire voluntarily ignited its very own foundation. They orchestrated what has to be one of the most spectacular, jaw-dropping, self-inflicted corporate disasters in modern financial history. They didn't just lose their crown to a competitor. Oh no. They effectively poured gasoline on their own castle, lit a match, and burned the whole thing to the ground.
So it begs an incredibly fascinating business question, a true mystery. What exactly happens when a monopoly destroys itself? How in the world does a company with absolute market dominance, massive cash reserves in the bank, and billions upon billions in guaranteed revenue completely collapse from a self-inflicted strategic wound? Listen, we see companies fail all the time, right? Bad products, tough competition, shifting trends, that's normal. But to completely vaporize billions in enterprise value and destroy your own undisputed cash cow while you are still sitting at the absolute peak of your power, now that is a special kind of business thriller.
You really have to wrap your head around the sheer scale of this dominance because it is almost hard to comprehend today. Over 40% global market share. Literally 4 out of every 10 people on Earth who bought this product were buying it from them. They had unmatched worldwide distribution, reaching deep, deep into emerging markets like India, China, and Africa, years and years before anyone else even thought to look there. This mysterious company literally had it all. They had the hardware locked down, they had the supply chain perfectly optimized, and they had the ultimate, unshakable trust of the consumer. And yet, this explainer is about to walk you through a sudden, catastrophic financial fall that completely wiped them off the map. You might already be piecing the clues together. You might be guessing who this absolute giant was. Well, let's go ahead and pull back the curtain. That's right. The unstoppable mobile giant was Nokia. Back in the 1990s and the early 2000s, Nokia wasn't just a phone company, they were the phone company, period. And what's crazy is they actually started out way back in 1865 in Finland as a pulp and paper mill. Yeah, if you can believe that, a paper mill. But they eventually pivoted into telecommunications, and by the early 2000s, they had become the undisputed world leader in mobile phones. They were absolutely famous for their extreme durability, incredible multi-day battery life, and for bringing real hardware innovation to the absolute masses. If you had a mobile phone back then, chances are it had the Nokia logo stamped on it. 250 million. Just let that number sink in for a second. That is the number of units the Nokia 1100 sold after its launch in 2003. It made the Nokia 1100 the best-selling mobile phone, and honestly, one of the best-selling consumer electronic devices of all time. Think about the sheer, unprecedented cash flow generated by a single product line, moving 250 million units. It's staggering. Nokia's financials were a fortress. They had captured the entire world. But, as we all know, when it comes to the tech sector, even the strongest financial fortresses can be completely breached if you miss a major paradigm shift.
Section 1. The iPhone disruption.
So the year is 2007, and the ground shifted forever with the arrival of the touchscreen. But Nokia's leadership tragically dismissed the iPhone. They literally called it a mere niche product. And man, this is where the financial rot truly began. You see, Nokia was heavily reliant on an operating system called Symbian. And compared to the rising iOS and Android platforms, Symbian was clunky. It was tied to physical keyboards and completely unsuited for modern, fluid touchscreens. But more importantly, its codebase was terribly outdated and incredibly slow to develop for. While Apple and Google were out there creating open, fluid software that developers absolutely loved playing with, Nokia's internal teams were actually fighting a civil war. Developers inside Nokia were building rival user interfaces, completely wasting immense financial resources, and totally missing out on building a unified app ecosystem. They were busy fighting each other, while the competition was building the future. The harsh, undeniable reality was this. The battle of devices had now become a war of ecosystems. Nokia kept treating the mobile phone market like it was just a hardware business. They honestly thought whoever built the sturdiest physical phone with the absolute best battery life would win the day. But Apple and Google, they realized it was now a software game. The real money, the true long-term investment value was in the ecosystem. It was the apps, the developers, the seamless software integration. Nokia stubbornly stuck to their outdated Symbian system. And by the time they finally realized they needed to pivot to a Linux-based OS called MeeGo, they partnered up with Intel, who didn't even have the right smartphone chips ready for the market. It was a massive, fumbling, strategic, and operational mess from top to bottom.
Section 2. The Burning Platform Memo. By early 2011, Nokia's market share was bleeding out, and the board of directors was in a state of absolute panic. They needed a savior, so they brought in a new CEO, Stephen Elop, to turn the massive ship around. And Elop did something unprecedented. He sent an internal company memo that quickly leaked out and totally shocked the global tech world. Just let these words sink in for a minute. We poured gasoline on our own burning platform. Elop told this vivid, terrifying story to his employees about a man standing on a burning oil rig who had to choose between burning to death or jumping into the freezing ocean. He used this chilling metaphor to describe Nokia's brutal financial reality. He openly, publicly admitted that they had completely missed the smartphone revolution. He pointed out that Chinese competitors were literally building physical phones faster than Nokia's management could build a PowerPoint presentation to discuss them. He admitted that Android and Apple were eating them alive. It was a desperate, incredibly raw wake-up call.
Now, if you look at this from an operations management perspective, Elop was actually using a classic textbook strategy for driving rapid corporate change. He knew he needed to create a shared goal, an intense, almost life-or-death urgency. By invoking a narrative of absolute crisis, he hoped to shock his sluggish, comfortable organization into rapid problem-solving mode. He was essentially telling investors and employees alike, guys, if we do not jump off this rig right now, we will die. The new strategy was suddenly crystal clear. Abandon the old Symbian, abandon the experimental MeeGo OS, and partner entirely with Microsoft to use Windows Phone. Sounds like a bold, necessary move, right? But there was a fatal flaw in how this was executed, and it triggered an unprecedented financial disaster.
Section 3. The Osborne Effect. Here is where the business thriller takes a really dark turn. Elop's burning platform memo didn't just motivate his employees, it absolutely terrified consumers and completely froze the company's massive cash flow. It triggered a very famous textbook financial phenomenon known as the Osborne Effect. Now, this term actually comes from a company back in the 1980s called the Osborne Computer Corporation. The founder of that company got a little too excited and pre-announced some amazing next-generation computers way before they were actually ready to ship to stores. So what do you think customers did? They completely stopped buying the current models. Sales plummeted to absolutely zero. Massive warehouses of inventory lost all their value, and the company went bankrupt simply because their cash flow dried up overnight. When Stephen Elop sent that burning platform memo out to the world, he essentially triggered the mother of all Osborne effects. Think about the impossible financial tramp Elop had just set for his own company. On one side of the equation, you have the Symbian cash cow. Yes, we know Symbian was outdated, but it was still generating massive revenues purely based on Nokia's incredible brand recognition around the world. But by announcing to the entire planet that Symbian was dead, Elop effectively told millions of loyal Nokia customers, hey, do not buy our current phones. They are obsolete. He killed his own cash cow overnight. But look at the other side of the equation. The massive problem was that Nokia's brand new, highly anticipated Windows phones wouldn't be ready to actually sell for almost another entire year. He destroyed his current revenue stream with absolutely nothing ready to replace it. Section 4. Billions in lost value. The financial markets just watched in absolute horror as Nokia's grand strategic shift turned into a ticking time bomb. Investors panicked and sold off. Consumers jumped ship to Android and iPhone, and the numbers just plunged off a cliff. Think back to 2007, when they were in untouchable monopoly, sitting pretty at 40% market share. Even by 2010, despite the iPhone being out for a few years, Nokia still held a very respectable 27%. But by 2013, just 2 short years after the burning platform memo and the big shift to Windows Phone, 5%. 5. They lost over a fifth of the entire global market in a span of roughly 36 months. It's almost hard to believe. And the reason was simple. Windows Phone completely failed to gain developer support. There were no apps, so consumers didn't buy the phones. And because consumers didn't buy the phones, developers flat out refused to spend time making apps for it. It was a classic, brutal financial death spiral. 4.1 billion euros. That is the devastating operating loss Nokia sustained over just 9 quarters during this chaotic transition period. 4.1 billion. They were burning through their cash reserves at an absolutely astonishing rate. Things got so bad that their pristine stock price was actually downgraded to junk status by Moody's.
It got so incredibly desperate that Nokia actually had to sell their own massive, iconic corporate headquarters building in Finland and then lease it back from the buyer just to raise emergency operating capital. The great untouchable tech giant of the 90s and 2000s was officially on its knees.
And the final financial insult came shortly after that. In 2013, Nokia completely threw in the towel. They surrendered. They sold their entire mobile device business to Microsoft for roughly 5.4 billion euros. Now, Microsoft thought they could salvage the whole Windows Phone strategy by finally owning the hardware manufacturing themselves. But the strategy failed so spectacularly, the Nokia brand was so deeply damaged by that point, and the broader consumer market had moved on so completely that just a couple of years later, Microsoft was forced to take a massive $7.6 billion write-down. Let that sink in. Microsoft essentially had to admit to their shareholders that the entire multi-billion-dollar acquisition was essentially worthless, and they ended up firing thousands of former Nokia employees. The bonfire was complete.
Section 5. The Aftermath. So, what exactly happens after a billion-dollar bonfire finally burns out? You might think this is exactly where the story ends and the credits roll, but it's not. After Microsoft completely abandoned the mobile hardware business, the rights to the beloved Nokia brand for phones were licensed out to a Finnish startup called HMD Global. And ironically enough, this startup was actually founded by former Nokia executives. And what did HMD Global do the second they got the keys? They immediately started building Nokia smartphones that ran on Android. They finally, after all the drama and billions lost, gave the market exactly what it wanted, just years and years too late. Now, while they haven't reclaimed their massive global dominance, they did manage to carve out a really solid, profitable niche for themselves in the budget and mid-range Android market. But wait, that's just the brand licensing for the phones. What about the actual original Nokia corporation?
Well, this right here is the true hidden survival story. The original Nokia executed one of the most mature, brilliant corporate pivots in tech history. Stripped of their flashy smartphone division, they took a hard look at their core competencies and decided to go all in on telecommunications infrastructure and 5G networks. They basically said, you know what, we are going to stop fighting Apple and Samsung for the gadgets in consumer pockets, and we're going to start fighting Huawei and Ericsson to build the actual physical backbone of the internet. And it worked. Today, Nokia is a highly profitable, massive enterprise business supplying the very 5G infrastructure that makes all of our modern smartphones function. They survived the absolute chaos by completely changing the game they were playing.
So let's bring this all together. What should you, as an investor, an entrepreneur, or just a fan of business history, actually take away from this? First off, adapt quickly or die. Nokia smugly dismissed touchscreens as a fad, and it cost them their entire empire. Second, software ecosystems will always beat hardware. It literally doesn't matter how durable your phone is or how long the battery lasts if it doesn't have the apps people rely on for their daily lives. Third, avoid poor strategic partnerships. Betting exclusively on an unproven Windows Phone OS over the globally accepted open-source Android was a fatal strategic error. And finally, always remember the Osborne Effect. Never, ever pre-announce a massive shift that instantly kills your current cash flow before your brand new product is actually ready to ship. Which leaves us with this final, incredibly provocative thought to chew on. Look around at the tech titans of today. We all know their names. Companies that seem utterly invincible, printing billions of dollars in pure profit every single quarter. They seem like monopolies that will last 1,000 years. But the Nokia story proves, without a shadow of a doubt, that no amount of cash in the bank, no amount of dominant market share, and no amount of historical prestige can protect a company from a fundamental shift in technology combined with a few disastrous leadership decisions. So if an untouchable fortress-like monopoly with 40% of the global market can vanish virtually overnight, how safe are today's tech giants really? Thanks so much for joining me on this explainer. I really hope it sparks some serious curiosity for you. See you next time.